Hello everybody and welcome to Crunch My Numbers, the podcast that offers you practical insights and strategies for business success. I am your host Paul Redmond, and today's episode is all about the process of selling a business, a significant milestone for any business owner and something the majority of business owners will only do once in their life. Selling a business is not just a transaction. This is an extremely complicated process that requires really deep planning and strategic execution. Whether you're selling now or sometime into the future, or just beginning to consider it or starting to have that conversation around when should I sell my business, what is the right time to do it, how do I process all of this, there is clear steps that will help you understand that and help you maximize the value for your business and ensure a smooth transition. Today we're going to talk about 8 of the steps that are involved, which will give you a fantastic insight into the overall process of selling your business. Okay, for stage 1 of selling your business is forward planning. And there's a number of key points here we're going to discuss when we're talking about forward planning. And I suppose the very, very first thing we want to discuss is starting early. And why should you start early? And what does starting early really mean? When I'm sitting with a business owner, one of the first things I actually like to talk to them about is, what are your plans for the exit? And some of these might only be starting up their business. But the more that you know and how you understand when you're trying to do that, that has a huge impact moving forward. So there's no such thing as too early to start planning your business. And as we go through all of these stages, you'll see why that's the case. But at the very basic minimum, you need to be 1 to 2 years out to give yourself the best opportunity to resolve any issues or make any improvements you need in your business, or just to get everything sorted out. The next thing is, what are the issues that you need to resolve before you sell your business? Well, the main issue that you need to resolve, if there has been any legal actions within your business, and if you have had anything happen within your business, in any case, any area, legal disputes will, and more than likely, potentially will scare off any potential buyers. But that's one part of it. The other part of it is it can significantly reduce the value of your business. But if all of this has been resolved, then it shouldn't have any major lasting impact on the value of your business if it's dealt with properly. The other thing is the ownership of assets and ensuring that all the assets within your business are captured properly. And some of these are intangible assets like goodwill, intellectual property, understanding, getting a clear ownership of if you have any assets in your business that are not particularly obvious, looking at all your fixed assets, making sure they're revalued to the current market value, making sure that the assets are actually still there, that are listed on your books and records. So that legal ownership of the assets is really, really important. And it's something that takes a bit of time and a little bit of effort. The other thing, if there's any disputes or conflicts within the business, and these can be disputes over a number of simple little things, like there can be rental of property or leasing of property, there can be internal disputes within the company, there can be staff issues within the company that you need to sort out. Just getting clear on if there is a dispute or a conflict, what that is, make sure that that dispute is actually clearly defined and there is a resolution for the dispute, or at least make sure that if there's no resolution possible, that you're aware of the implication on that. Because all of these disputes, all these issues, if you don't resolve them prior to the sale, we have seen in a number of occasions where the disputes arise during the due diligence phase of the business, and it can actually lead to the sale not going through. And so be very, very clear if there is disputes, make sure they're captured. The next thing we need to look at is optimizing the performance of the business. A business will be sold based on the better the performance, the more value the business tends to have. So if you've planned this way back and you've loads of time to plan, you can streamline your operations insofar as you can help to improve the performance of your business. So evaluating your business operations, identifying areas where you can streamline processes, reduction of costs, improved efficiencies. Well-run operations are more appealing to buyers. So if you're going to buy an operation that's really well run, really well laid out, you'll be a lot more inclined to purchase that business rather than something that you have to do a lot of work in. There may be some restructuring needed, and restructuring might be reorganizing departments, updating your business model. Even you might have some areas of your business where you have to divest before the sale actually happens. So it gives you time to restructure that, to get rid of underperforming assets or underperforming people or underperforming customers or suppliers. And the other thing then would be to boost your revenue. So exploring ways to boost your revenue, where people will say that's always ongoing in the business, no matter what happens. But if you're trying to sell your business, you get that renewed energy, and you will demonstrate areas for recent revenue growth. You can significantly enhance the value of the business in the last 3 to 4 years of the business life. The next part that we're looking at in the forward planning is the financial health and record keeping. Doing a financial audit for your business, conducting a thorough audit of your financial records to ensure accuracy and completion. Buyers will be scrutinising these, and their advisor will scrutinise all your financial records during the due diligence phase. So having a clean and transparent and records that are easily understood and easily accessible, it just really and truly enhances when somebody is looking at it. Simple little things like if you have a company, having your company register up to date, having all the different types of the registers up to date, having your minutes of your meetings up to date. All of these things are good financial health checks. Making sure that your financial statements then are detailed and that they include income statements, balance sheets, cash flow statements for at least the last 3 to 5 years. And these documents will provide a buyer a perfect and a good, clear picture of your financial health of your business, subject to them being done in the appropriate manner. One other massive financial area and record keeping is your tax compliance. Ensuring that all tax filings are up to date, there's no outstanding tax liabilities. Any issues with the tax office can delay the sale or the purchase or sale of your business. And it can also affect the purchase price of your business significantly. So having that good history, it's not saying that every single tax return, if not filed on time, but people will look at history. They will also look at the timings of how these things are done. They're really, really clear and really important. So that's really the very first stage of it, which is the stage of forward planning. So the next stage is a stage everybody looks forward to, and is valuing your business. So how do you value your business, and what are the points you need to look at in determining what the value of your business really is? So I suppose, first of all, you have to decide, what am I actually selling? Am I selling the entire business or a partial sale? Am I selling the intellectual property of the business and the goodwill? Am I selling property if it's attached to the business? Am I selling the customer contracts? So having a clear, crystal understanding of what's actually for sale is so important. And it's a difficult one to see. Like, some people just sell everything, walk away. Other people divest part of their business. So the value will determine what's on offer for sale, but also it might have an impact if you're selling part of your business, but some of that is dependent on the other part of your business. The next thing is, how do we value the business? What are the techniques and what are the approaches to value your business? And there is a load of different technical approaches out there, accounting and financial and analytical approaches to sell your business. But the business is actually worth what somebody is going to pay for it. I know that's very, very simple, but it's also very, very true. You can have an approach where you will be able to use normal criteria for valuing, and some of those criteria are things like the income approach. This values the business based upon the income that the business can generate into the future. It's typically done through what we call a discounted cash flow analysis, where we look at future cash flows that are projected and then we discount them to the present value of today. That's the income approach. The other is the market approach, which involves comparing your company to similar businesses in the particular area and in the markets that have recently been sold. This method is used for industries with active markets and plenty of comparable assets. The other is the asset-based approach. And the asset-based approach is where the business is based on the value of its assets minus its liabilities, what it owns minus what it owes. This method is often used where we have significant physical assets in the business and where the business is not generating significant income. Another one then would be the industry specific considerations. So you would have different valuation methods in different industries. And what I mean by that is we use a thing called EBITDA, which is earnings before interest, tax, depreciation, and amortization. And there is a little anomalies with each of these particular methods, but that is a very commonly used method. But then what we take is we take that profit or that EBITDA calculation and we use a multiplication factor depending on the industry that it's in. And that's how you come to a market valuation or a valuation that can be used in this. But what are the factors that actually affect the value? I suppose there's three main factors. There's the growth potential, there's the competitive position, and there's risk factors within the businesses. So the growth potential is buyers are often willing to pay a premium for a business with high growth potential. So if there's massive future opportunities coming down the line and people that are expanding into new markets or launching new products, this can absolutely enhance the value. And if you're using the growth potential, you're looking at the income method. So you're combining the method with the factor. The other thing, the competitive positioning. So if you have a real strong position in your market and you're a dominant market share and you have your own unique selling point, this can enhance the value a lot. The other would then be the risk factor. So considering the risks associated with your business, such as reliance on key customers or suppliers, regulatory challenges are a big one, and also the volatility in certain markets can have a big impact. These risks can affect the valuation, so we need to be prepared to address these. Other risk factors would be licensing. So if you had a particular license for your business, and if you can't renew that license, that has no value. So you have to have a clear understanding in that area as well. And now we come on to valuing the business. Who should value the business? Well, what I will say to you is hire a professional valuer. Valuing a business is a complex and requires expertise. A professional valuer that can provide an objective assessment, they'll ensure that they've considered all the factors we're talking about here. So look for a valuer with experience in the industry and a strong track record. And then they should also be able to sit down and explain the valuation methods to you clearly, and then justify why they have picked that particular valuation. If you're a business owner, you'll have a good feeling about the value of your business anyway. You're going to have an idea what you believe your business is worth. Just having that good feeling will actually, if you get a good valuer that can explain what they're doing, they can justify that back to your valuation. The next stage we're going to look at is tax planning. And there's some key points here, which is understanding the tax implications, structuring your sale, using tax reliefs, working with advisors, a tax advisor. So those are some of the main areas within the tax planning. So understanding the tax implications, having a tax advisor working with you, and the earlier the better again is possible, because we can plan to avail of certain allowances and reliefs that are available if you go to sell your business. And this is particularly dependent upon where you're located in the world if you're listening to this podcast. So you have to get tax planning depending upon your own particular area and where you're located. But the main areas that I would be talking about would be capital gains tax. So what are the considerations when selling a business? One of the considerations is obviously capital gains tax. That's the tax you pay on the profit you make on the sale. And this can have a significant impact depending on the rate of capital gains tax on the sale of the business. But is there a way to bring down the capital gains tax? And obviously there is a way to bring it down. There's planning can be done to structure that, and we'll talk about that in a minute. So depending on the business structure, the sale might be subject to personal income tax or corporate tax or both. So understanding how the sale will be taxed can help you plan accordingly, and it will have a big effect on the value. And the other thing is timing. The timing of the sale can affect your tax liability. Selling at a particular point of time in the year may help you spread the tax burden. So tax implication, massive important to have a tax advisor on your case. The other one then would be how do we structure the sale? So once we have the tax planning done, how do we structure the sale of the business? And we're looking at things like a share sale versus an asset sale. In a share sale, the buyer purchased the shares of a company, taking on both the assets and liabilities within the company. In an asset sale, the purchaser buys specific assets, allowing them to take those assets out of the business. So each different structure has a different tax implications. We then have things like earn-out agreements, and an earn-out agreement allows the seller to receive part of the purchase price based on business's future performance. This can be a way to maximize your tax advantage. So an earn-out may be tax efficient in some particular cases. And then deferred payments in terms of the sale. So structuring the sale where deferred payments can be spread your tax liability over a period of time, potentially reducing the overall tax burden on the sale. What are the main reliefs? Again, be very careful that this is dependent upon where you are. We have things like entrepreneurial relief, which is, and it's equivalent, there might be something equivalent in your jurisdiction, which can significantly reduce the capital gains tax on the sale of your business. To qualify for a lot of these, you must meet certain specific criteria. So again, it's very, very important to plan ahead. Rollover relief may be present in your jurisdiction, so which means that if you sell your business, you might be able to roll that over into another asset, which defers the gain until the new asset is sold. And then we have a very popular one in our area, which is retirement relief. In some cases, selling your business as part of a retirement plan may qualify for additional tax relief. So consulting a tax advisor to explore these options is critically important. So I just want to talk about working with a tax advisor and why it's so important. Proper tax plan can make a significant difference in how much you keep from the sale of your business. A tax advisor can help you navigate the complexities and the structure of the sale in the most efficient way possible. So choosing the right tax advisor is so critical to this. So looking for a tax advisor with experience in business sales and a deep understanding of all the tax laws. They should be very proactive in identifying opportunities for tax saves and help you explain the different implications of different strategies. So you're looking for someone that's going to help you plan and advise. You're not looking for someone to do a transaction-based sale. So they'll advise you on the transaction you've done. So planning and timing is critical. The same applies for working with legal advisors. So you really do need to have such a good legal advisor when you're selling your business. And the same thing, proper legal advice can make a significant difference in the sale and how much you keep from the sale of your business. So a legal advisor, they'll help you navigate the commerciality and the commercial legal requirements that you need to do on the sale of your business. Again, critical point is having the right team around you. Building your team is so important. So next stage is marketing your business. And the key points here are to get the word out that your business is for sale at the right time. What are the strategies you're going to use to market your business? What materials do you need to have? And how do you maintain confidentiality while you're selling your business at the same time, which is something that everybody worries about, maintaining that confidentiality. So in terms of marketing your business, the importance of marketing, even if we have a really good, well-prepared business for sale, it won't sell if nobody knows it's for sale. So effective marketing is critical to potential buyers. People need to know where to go to find out about your business, first of all. There's loads and loads of people out there to buy your business, but they might not know about it. And that's one of the biggest issues we have in business sales is marketing your business. So how do you do that? You get a target audience. So you identify the most likely buyers for your business. And these may be competitors, they may be private equity firms, they may be individual entrepreneurs. So tailoring your marketing efforts to reach your specific audiences. And you might have a number of people that you would like to purchase your business. So having a methodology of somebody going to them, in a proper manner and telling them this business is for sale and you're on a preferred list and how you go about that. So that's one of the ways of getting the word out there. The other strategies would be business for sale, websites. There's websites out there to sell business. There's business brokers out there. There's industry publications, and there's the direct outreach. I always find that personally for me, and it's not that I've one over the other effort, but a direct outreach approach tends to have a better approach to somebody looking, because you will get a lot of people out there who are just looking for information on your business, and it's a great way to get it if you're looking at just looking at the business because you want to see what's going on, and you can't tailor those people out really. We then need to create the marketing materials. So what marketing materials are usually needed when you come along to do a business sale? First one really is an information memorandum. So that's a document that provides potential buyers with detailed information about your business. It should include overview of your business, financial performance, market positioning, growth potential, and anything else that you believe would be of interest if you were going to buy a business, a similar type business. That's the information memorandum. We then have a teaser document. So it's just a brief overview designed to pique the interest of a potential buyer without revealing too much information. It's used to kind of engage interest while maintaining confidentiality. Then we have the obvious websites and social media. If appropriate, you can use your business's website and social media channel to discreetly promote the sale. So there's a few kind of main heading areas there to create the marketing material. But what people want to know is, how do you maintain confidentiality? And you can have forms signed and there's things we'll talk about there, but at the end of the day, you're dependent upon somebody's ethical agreement not to talk about it. But in a lot of cases, people do that. They maintain the confidentiality. But why does it matter? Because if customers or suppliers or employees find out that the business is for sale, it could destabilize the business, it'll create uncertainty, and it can potentially reduce the value. So confidentiality is crucial to maintaining stability during the sales process. How do you do that? Well, there's a thing called a non-disclosure agreement, an NDA. So before sharing detailed information with a potential buyer, ensure they sign an NDA. This legally binds them to keep the information confidential. And you will get one of them from your solicitor that you're going to engage. Discretion then in marketing. Be mindful how and where you market the business, because avoid public announcements or advertisements that could alert the wider market to the sale. Work with advisors to ensure that all communications are handled discreetly. So the next stage is identifying the best purchaser for your business. And the key things here, we're going to talk about identifying potential buyers and evaluating. How do you evaluate the potential buyers? And then you're going to look at negotiation with multiple buyers and maintaining confidentiality again. So these are the kind of the main risk or the main areas within the identifying the best purchaser. So identifying potential purchasers, we're looking at either internal or external buyers. Your potential purchasers could come from within the company, such as key employees or partners, or from outside, such as competitors, private equity firms, or individual investors. There are strategic buyers out there who see your business as a way to enhance their existing operations. They might be willing to pay a premium for the business because they're going to get a competitive advantage or synergies from working with your business. Strategic buyers would be somebody whom would be a large customer to you, and it might suit them to buy the business to help them overall reduce the costs. And there are financial buyers out there. These would be things such as private equity firms. They're interested in return on their investment. So they're often looking for businesses with a really strong cash flow, good potential, but they tend to be a bit more price sensitive than your strategic buyers. And if we're going to evaluate the buyers, then the main thing is they need to have the financial capacity to buy your business. So they need to be able to prove that they have funds to purchase the business. And that's a really important point to make. So they need to be able to secure the security of proof of funds will be needed before we kind of really get into deep negotiations with these people. The other thing, which is not often talked about, but it's also really important, is the cultural fit. So we need to consider whether the buyer's values, core values, and core focus, which you've heard me talking about possibly in every episode of the podcast that I do, are the core values and core focus. So is this a good cultural fit? And can we ensure a smooth transition from their business to your business? Because if you can't do that, it's going to be really difficult to make the business successful. And what are the post-sale plans? So understanding, the buyer's plans for after the business sale. Are they going to be able to integrate into their operations? Are they going to keep it running independently? Are they going to make significant changes? These are all plans that can impact the future, the business's future and your legacy, but also impact if you're getting income from these later on down the lines of as a part payment sale. So how do you negotiate with multiple buyers, you need to create a competitive environment, the same as anything. You need to pique the interest from multiple buyers. This creates a kind of a competitive environment that drives the price up. It's important to manage this process carefully because you might alienate some serious buyers by just saying largest offer. So if you're going to negotiate with multiple buyers, you need to weight the offer. So don't just consider price. Look at culture, look at the terms of the deal, look at the payment structure, look at the post-sale involvement and any other contingencies. And again, maintaining confidentiality throughout all of this. So selling your business should always be on a need-to-know basis, should be tightly controlled, and we only share details with serious buyers who have signed NDAs. If somebody won't sign an NDA, don't give them the information. Again, it's using the advisors we've talked about in every step, and it is really important working closely with your advisors to manage communications and ensure the confidentiality is maintained throughout the process. Believe it or not, one of the most important things to look at in the overall sale of a business is and always will be the project management. And it's an area that's often overlooked, but you're going to have multiple parties within a business sale, and all those parties have an interest in it, and the communication and the project management of that can tend to massively affect the deliverable at the end. So now we're going to look at the actual stage of negotiation and what are the key points here in this stage. And there's 4 stages within this. So set your targets, have negotiation tactics, involve advisors, don't do it yourself, craft the deal. So they're the big stages in it. But within each of those stages, so setting your targets, before you enter negotiations, you need a top target price that you would likely to achieve. So what is your best case outcome? Being realistic of what the market will actually bear. The next thing you have is you need to have the lowest walk away price. So you need to set what you're just not going to sell for anything lower than that, the minimum you're willing to accept. And understanding your boundaries help you to stay focused during the negotiations. And then there's other considerations to price, which we talked about previously, such as, well, there's the structure of the payment, there's your future involvement in the business, and there's any post-sale commitments that you're going to have to give. But that massively helps the negotiator when he knows the top price and the walkaway price. Then he has a gap to work with. Effectively negotiation, some of the tactics that really give you an effective negotiation are, don't name your price first. Let the buyer make the first offer. Sometimes it's really difficult here, but it is a really good point. Understand the buyer's motivations for the purchase of this. If you can get in around why they want this business, then it's really going to help you. That helps you craft a more compelling proposal. Another really big one is be prepared to walk away. Walk away is one of the most powerful tactics that you can use. If the deal doesn't meet your expectations, thank the people and say, look, we're really serious about what we're trying to do here, and this doesn't work for us at this point in time, so we're going to walk away. One of the main reasons why you have advisors within a business sale are to keep your emotions in check. Negotiations can be extremely emotional, especially when you're selling a business that you create from the ground up. You need to stay objective and focus on the facts rather than getting caught up in emotions. That's why you should never negotiate the sale price yourself. I won't say never, but in most circumstances, you should have a negotiator doing it for you. This is why it's important involving advisors in it. So there's roles of financial advisors can help you understand the different offers. There's legal advisors which are crucial in ensuring that the deal can actually take place and be carried out. The tax advisors we've talked about, what their role is making sure that you minimise your tax liability. You have a second negotiator. It's often helpful to have 2 people bouncing off one another. One person is the key negotiator with ultimate responsibility. The second can act as a sounding board. So you can have another person going in that just keeps the momentum moving. And it helps to get a balanced and more effective negotiation. And then we have the art of crafting the deal. So when we go to craft the deal, there's 3 main things we need to look at. 1 is payment structure, 2 is contingencies, and 3 is the post-sale involvement. So we need to consider how we're going to get paid for the business. Is it lump sum, installments, or earn-out on future performance? The contingencies are looking at negotiating to protect your interests, and you need to really have a good person involved in setting these contingencies because both sides will have their own angle to play at this. And then the post-sale involvement, you need to understand if you want to, or are you going to stay in the business after the business sale. So you need to be able to negotiate these in this stage of it. The penultimate stage is the due diligence stage, and this stage can It can be very invasive. So again, have your advisors do this. So the main key points here would be conducting a deep dive, legal due diligence, commercial due diligence, financial due diligence, and preparing for the due diligence, organizing the documentation, etc. Due diligence is the buyer's opportunity to thoroughly examine the business. So he'll want to look at everything he can within the business. That's why we talked about the very first episode of preparing the business for sale. The more preparation you have done, the better the due diligence will be, the area of this. So it kind of focuses on three main areas: legal, commercial, and financial. And each area involves a detailed review of documents and information to identify the issues. Like the purchaser needs to identify any of these issues up front because he's left with them after you go. The legal due diligence will look at reviewing of contracts, significant contracts in the business, customer supplier agreements, lease, employment contracts. So having these up to date is critically important. If there is any intellectual property or IP, he'll need to conduct a thorough review that's properly registered or trademarks. He'll need to look at if there's any disputes available. So litigation history is a huge part of it. So the buyer will investigate any past or ongoing litigation involved in your business. So if you haven't disclosed it at this point and they find it, it's a big, big red herring to somebody coming in to purchase a business because you've lost the trust there. And then you have the compliance, the legal compliance. So just ensuring that relevant laws and regulations and licensing and industry-specific requirements, if there is any environmental regulations or there is any employment laws that need to be considered at that point. So the legal due diligence is a heavy document and it's a heavy piece of work that needs to be done. We then have the commercial due diligence. So the buyer will evaluate the market position, your customer base, and your supply chain. Three big things. So he's going to look at the competitive strengths, the market share, the growth potential, and be prepared to provide detailed market research and analysis on your business to prove your case initially that you said. He'll look at the customer base, look at the key customers, the concentration of them, and the customer satisfaction. So a diverse, loyal customer base is a positive indicator. So if you go in and you have a longevity there, you have a large history with a family or a group of people, that does help. And you'll assess the age of them just to make sure that they're not coming to the end of, that customers come to the end of their natural life. Big part of it is looking at supply chain and ensure that it's stable, reliable, and capable of, supporting the future growth. That'll include reviewing kind of relationship with key suppliers and addressing any potential issues that you had in the supply chain. We have had a lot of supply chain issues, in the last 7 or 8 years across the world with COVID and with everything else that's going on. So supply is an issue that needs to be considered. We then come on to the financial due diligence. So the financial due diligence is next. So what happens within financial due diligence? So we'll review the financial statements. They'll scrutinise your profit and loss or income statements, balance sheet, cash flows to prove and verify your results. They will audit your financial records, which would be looking at bank statements, potential tax returns, accounts receivable, accounts payable, general bookkeeping. They'll look at your revenue and profit margins. They'll analyse your revenue streams and your profit margin and looking at growth and histories. They'll look at the debts and the liabilities in terms of loans, credit lines, contingent liabilities. So all of this is standard financial due diligence. And the amount of due diligence they will do will be dependent upon what you have done up front as well. So, you're looking at substantive work up front, potentially reducing the work that needs to be done here. Because all they're doing then is they're not looking for stuff, they're proving the information that they've got, which leads to less amount of due diligence in the long run. In order to prepare for your due diligence stage, then you need to start organising all the relevant documents and have a hub to create a data room. A data room is an area, a secure data where all documents can be put up and stored and assessed or accessed by the buyer's team. It allows for a lot more efficiency, and that comes into the project management area of this as well. And then, addressing potential issues up front. Be open and upfront and honest about the potential issues that are going to be there. That I cannot stress enough how important that is at the very, very start. So that's just looking at the due diligence stage of your business. So the final stage in a business sale is closing the business sale or closing the deal. And the key points here are stay focused, stay on track, finalising the terms, handling the formalities, the legal formalities, the transition period of the handover process, and then it's celebrating the sale. which is really important as well. So staying focused. This is probably the most frustrating part of it, because you've shook hands, you've done the deal, they've done the due diligence, and then they have to go through all the process of actually closing the deal. And this is where the rubber meets the road, as they say, and it's where all of the people come together. And again, I'm saying it every time, it's the project management. So staying focused, avoid distractions. As you approach, it's crucial to stay focused on both the sale and keep the flag flying, keep the plane flying. Don't stop the operations of the business because you're too focused on the sale. If you lose focus on running your business as they get closer to the sale, it can lead to a lot of last minute complications. The operational continuity. So when someone steps in, when you step out, that's really important. So you need the handover process there. Then keep the lines of communication open with your team and the key stakeholders. And remember the saying, the biggest problem with communication is the illusion that it's actually taken place. So communication is really important. Project management. So finalising the terms then would be things like the sale agreement, the payment terms, the representation and the warranties, and the closing conditions. Your legal team will be heavily involved in this. They'll have all of this done, but it's just making sure that all of that is done and in place. And then we've just handling the legal formalities, the actual transfer of ownership, signing of the sale agreements, the transfer of shares, updating the corporate records, and ensuring that all this document is done, prepared, signed, and handled smoothly. And you will have things like the regulatory approvals. Depending on the nature of your business, you might require regulatory approval, such as, if you've antitrust or industry-specific licenses are really important to make sure that the work on the legal team, that all these necessary approvals are obtained, and then you just file the tax filings. Then you have that little weird transition period where the handover process, communication with the people, and the post-sale involvement. So that part of it is the very, very last process. So you smooth handover, communicate with all the people, including employees, customers, and suppliers, in a way that reassures them that it's just a step in the natural chain of the business, that keeps the confidence up in the business. And the more confident you are with this communication, the better the process for the person coming in. And then the post-sale involvement, what have you agreed to? And just make sure that the roles are clearly defined, because you're now no longer the owner of the business. Just remember that, and you can't act like an owner. And that's a part where there's usually a little bit of problems comes in. And the very, very last part of this is recognising the achievements. It's a significant achievement. Celebrate it. Go and celebrate the hard work that got you to this point, and celebrate with the team of people that have got you there. Moving forward after the sale then, there's a lot of people going into another adventure. There's a lot of people take time off, exploring new opportunities. Whatever your plans are, the sale marks the beginning of a new chapter. Someone said that to me once, and it was a really important part, because people, thought it was the end of something. It's the start of a new chapter. So if we can just recap now everything. This has been a long enough episode, so thank you for staying to this point. But we walked through the 8 critical stages of preparing your business to sell, from forward planning to valuation to negotiation to closing the deal. Each sale requires careful consideration and strategic planning to ensure this happens. So my last thoughts on this really are, selling your business is one of the most important decisions you'll make as a business owner. But by taking the time to prepare thoroughly, understanding the processes, work with a team of experienced advisors, you can maximise the value of your business and achieve a smooth, successful sale and a transition of your legacy to the next group of people that have it. So for me, Paul Redmond, if you consider selling your business, start planning early, consult us. We'd be delighted to have a conversation with you and help you guide you through that process. And if you have any further questions or need assistance, please note that I'm here to help. Thank you for tuning in to Crunch My Numbers. I hope this podcast today provided with you valuable insights on selling your business. And chat very, very soon. Thank you.